Welcome to the Pro Ticker Deep Dive.
It's great to be here.
Today is Friday, February 6, 2026. And I have to be honest with you, looking at just the absolute mountain of research and reports and data we have on the desk today, I feel like I'm losing my mind a little bit.
Chuckles? Yeah.
It feels like we were living in two completely different universes at the exact same time.
It definitely feels that way. I mean, it's a phenomenon that the research team is calling multidimensional polarization. And, it's not just a fancy buzzword.
Right.
It really is the only way to describe the current reality.
Multidimensional polarization. Okay, that sounds intense. But it fits, doesn't it? Because on one hand, I look at the screens, and the S&P 500 is what? It's flirting with 7,000.
Yellow goes there.
We're seeing corporate earnings that are just absolutely booming. The AI supercycle seems to be printing money like it's going out of style. I mean, if you just looked at a stock ticker, you'd think we were in a golden age.
Right, a complete golden age. But then you look away from the ticker.
Exactly.
Yeah.
Then I look at the headlines or, talk to regular people, friends, neighbors, the guy making my coffee, and it feels shaky. It feels dangerous.
Shaky is putting it mildly. I mean, we are looking at what we're calling a hiring recession, despite a growing economy.
A hiring recession.
Yeah. And then you have geopolitical shockwaves that sound like, I don't know, the plot of a Tom Clancy novel. We've got special forces in Venezuela, a diplomatic crisis over purchasing Greenland, and then at home, a consumer base that is just splitting right down the middle.
It's a lot to process. So our mission for this deep dive is to try and connect these dots. We need to figure out how the economy can be growing while hiring is stalling out completely. We need to understand how that massive tax bill signed last July, the One Big Beautiful Bill Act, is actually hitting wallets right now, today.
Yeah, BBA.
And we absolutely need to talk about why gold, which was, it was everyone's favorite asset last year, just completely fall off a cliff.
It is a lot to unpack, but if you look closely, I think the key to understanding 2026 is realizing we have left the pandemic recovery era completely behind us.
That's over.
It's over. We are now in a new era of what you could call orthodox management combined with artificial intelligence realism. And that transition, it is incredibly bumpy.
Okay, let's start there. Let's start with the mood.
Yeah.
Because looking at the data, GDP is growing. We're seeing a healthy 2.2% growth rate.
Solid. Not amazing, but solid.
By historical standards, that is solid. It's not explosive, but it's definitely not a recession. The stock market, as we noted, is at record highs.
Yeah.
But if you look at consumer sentiment, if you look at how people feel, it's depressed. It's dark.
Right. And there's a term floating around the institutional research that describes this perfectly. Vibepression.
Vibepression. Okay, I have to stop you there. That sounds like a marketing buzzword designed to dismiss real economic pain. Oh, you're just feeling bad. It's a vibepression.
I get it. It does sound dismissive, I agree, but the data really backs it up. It's describing a very real disconnect.
Okay.
You have the hard economic, data GDP, asset prices, corporate profits that says everything is great, everything is booming. But the vibes, the consumer sentiment, the day-to-day experience of the average person feels like a recession.
So it's not just that people are grumpy.
No, not at all. It's that their personal economy is decoupling. It's breaking away from the national economy that you read about in the headlines.
So why the disconnect? What's driving that? Is it just like leftover inflation trauma from a few years ago? Or is something else fundamentally broken?
That's definitely a part of it. That inflation scar tissue is real. But the main driver right now, the thing that's really causing this feeling is what's happening in the labor market.
Hiring recession, you mentioned.
Exactly.
Yeah.
We are calling it a hiring recession. Now, this is a really crucial distinction, so we need to spend a minute here.
Okay.
Usually when the economy gets tough, you see layoffs.
Right.
You see these massive spikes in unemployment claims.
Right. Companies start firing people. You see headlines about mass reductions in force, 10,000 jobs cut here, 5,000 there.
Exactly. But we aren't seeing that, not at all. In fact, layoffs are at historic lows. If you have a job today, you are statistically very, very safe.
Why is that?
Because companies are holding on to the workers they have for dear life. They remember how incredibly hard it was to hire back in 2021 and 2022. They are hoarding labor.
Okay, so nobody's getting fired. On the surface, that sounds good. So why does it feel bad?
Because the problem is on the other side of the equation. The exit door is locked, sure, but the entrance door is bolted shut. They absolutely are not hiring anyone new.
So the churn, the movement in the market has just stopped.
It's frozen completely. If you look at the employment data that was just released for January, and you look at the trends from late 2025, non-farm payrolls are growing incredibly sluggishly.
What are we talking about?
We are averaging something like 28,000 jobs per month recently.
28,000 a month. I remember back in 2024, we were seeing numbers in the hundreds of thousands. 28,000 that's barely a rounding error for a country this size.
Exactly. For an economy with over 160 million workers, that is basically stagnant. It's a flat line. And this is where that artificial intelligence realism we talked about comes in. We spent years, talking about AI as this abstract future tech. In 2026, it is infrastructure. It is the engine.
This isn't just ChatGPT writing funny poems for your kids' homework anymore.
Far, far from it. This is real-world deployment. Investment in software is rising at 16% annually. Data center construction is up 22%. Companies are finally seeing those productivity gains we were promised for so long.
And what does that look like on the ground?
It means they're implementing AI agents that handle customer service, logistics, supply chain management, even mid-level coding and quality assurance.
So they can do more, a lot more, with the exact same amount of people.
Precisely. They are growing revenue, they are growing GDP, but they don't need to add headcount to do it. So if you have a job, you're probably safe because you're more productive than ever. But if you lose your job, or if you're a new grad just entering the market, it is brutal out there.
There are no seats at the table.
There are no new seats. And that explains the quits rate data I saw in the notes. It's drifted lower and lower.
Right. People aren't leaving their jobs.
Workers aren't stupid. They sense the market is tight. They know they can't just walk across the street and get a 20% raise anymore like they could 3 years ago.
The Great Resignation is long gone.
A distant memory. So everyone is staying put. The labor pool is stagnant, and that creates this feeling of uneasiness, this vibe-pression. Even if you are employed, you feel stuck. You feel like you have no leverage.
And if you have no leverage, you probably aren't asking for a big raise.
No.
Which means wages might be stagnating even if headline inflation is finally low.
Exactly. Your real wage isn't growing much. And that feeling of being stuck, or for many, the reality of wage stagnation, is showing up in a huge way in how people spend money. We are seeing a serious split in the consumer data.
This is the K-shaped recovery concept, right? We've talked about this before, but it sounds like it's getting more extreme.
It is the classic K-shape, but on steroids. If you look at the spending breakdown by income, it tells two completely different stories that might as well be from two different countries. High-income households are driving what we call wealth-driven spending.
Because their 401ks and their stock portfolios are way up.
Exactly. The S&P is near 7,000. Their home values are holding up. They feel rich because, on paper, their assets are rich. So what are they spending on? Spending on education is up 14%.
14%, wow.
Yeah. Spending on experiences and culture concerts, travel, theater is up 3.6%. They are spending money on bettering themselves, private tutoring for their kids, and, having fun.
But the other side of the K, the people who don't own a big slice of the S&P 500.
Yeah. It's a different world entirely. Lower and middle income consumers are becoming aggressively value conscious. They're pinching every penny. Spending on food is actually down 2.4%.
Wait, hold on. I have to stop you again. Spending on food is down. People have to eat. You can't just decide to stop eating because the job market is tight. How is that possible?
They do have to eat, but they are trading down aggressively. It's a flight to value. They are shifting from name brands to generics. They are shifting from Whole Foods to Walmart or Aldi.
And changing what they're buying, I assume?
Absolutely. They're changing what they eat. Less protein, more starch. And it's not just food. Look at clothing and footwear. That spending is down nearly 9%.
9%.
That is a massive contraction. That's a recessionary number for that sector. It tells you that for a huge chunk of the country, there is no discretionary income left. None.
So that is a really stark picture.
Yeah.
You have one group buying theater tickets and private tutoring for their kids, and another group figuring out how to stretch a pasta dinner for another night because they can't afford new shoes for their own kids.
And that dichotomy, that split, is what fuels the vibe-pression. The averages look fine because the high spenders pull up the numbers. It's like the old joke, If Bill Gates walks into a bar, on average, everyone in that bar is a millionaire.
Right.
But the median experience, the typical person's experience, is stressful. It's tight.
And this leads us perfectly into the fiscal situation.
Yeah.
Because usually, when the working class is struggling like this, trading down on food, not buying shoes, You might look to the government for some kind of support.
For a safety net.
Exactly. But the government has drastically changed its approach with this new legislation. We need to talk about the One Big Beautiful Bill Act, or OBBA.
OBBA, signed into law on July 4th, 2025, a very patriotic date. And we are really, really feeling the impact now in early 2026.
I have to say, the name One Big Beautiful Bill Act sounds like something a child would name a law. But the contents are incredibly serious and have huge consequences.
It's certainly branded distinctly. But you're right, the core philosophy here is a massive fiscal impulse. It's designed to pump up GDP by permanently extending the tax cuts from the previous decade and adding some very specific, very targeted new incentives.
It's pure supply side.
It is supply-side economics taken to the absolute limit.
So let's get into what you call the dinner party details. These are the things that listeners are probably hearing about, maybe debating with their friends right now. What are the headline changes hitting people's bank accounts?
The biggest one, the one that is, frankly, politically brilliant but economically fascinating, is the no tax on tips and overtime.
I've heard so much about this. Sounds great on a bumper sticker. Keep your tips.
It does. And for service workers, for hourly employees, it is a major, major shift. It is valid through 2028. If you work a double shift, that overtime pay is yours. No federal income tax on it.
So to be clear, payroll taxes still come out.
Yes, that's a key point. You still have to pay into Social Security and Medicare. But the income tax portion, which can be significant, is gone.
Okay, but let's play this out. If tips aren't taxed, doesn't that create a massive, massive loophole? What stops a hedge fund manager from restructuring his 2 and 20 fee as a tip?
That is the billion-dollar question. The IRS is currently scrambling to write guidance on what constitutes a tip, because you are 100% right. If I'm a consultant, can I lower my hourly rate and ask my client for a tip at the end of the project? It creates a huge incentive for tax avoidance and reclassification.
So it's an administrative nightmare.
A complete nightmare. But for the actual waitress or bartender, it puts more cash in their pockets immediately, no question.
And the overtime piece. How does that change behavior?
That's arguably more impactful for the broader economy. It effectively increases the hourly wage for overtime work without the employer having to pay a single penny more. So it encourages people to work 50, 60 hours a week. It's a tool to solve labor shortages by just squeezing more hours out of the existing workforce.
Which ties back directly to the hiring recession. Why hire a new person with all the overhead when your existing guy is desperate to work overtime tax-free?
You nailed it. It reinforces the no new hires dynamic. It makes it cheaper to burn out your current staff than to expand your team.
Okay, what about the car loan deduction? I saw that in the notes and thought, finally. Interest rates have been high for a while. Car payments are absolutely brutal for a lot of families.
It is very popular, but there is a big catch. You can deduct up to $10,000 in auto loan interest, which is great, given where interest rates have been. But the vehicle must be assembled in the United States.
So it's industrial policy disguised as a tax break.
That's exactly what it is. It's designed to steer consumers toward domestic manufacturing. If you buy a Ford or a Tesla made in Texas or a GM from Detroit, you get a break. If you buy a German import or a Japanese car that isn't assembled here, you don't. It's protectionism through the tax code.
And then there's the rural opportunity zones. This one had a term that confuses me and probably a lot of our listeners. Step up in basis. Usually I hear that when someone dies and passes stock to their kids. How does that apply to me investing in, say, a farm in 2026?
This is a really technical but incredibly powerful provision. And you're right, usually step up in basis happens at death. Your heirs get the asset valued at current market prices, so all the capital gains tax from your lifetime just vanishes. This law applies a version of that to living investors in designated rural areas.
Okay, explain that to me like I'm 5.
Chuckles. Okay, say you buy a warehouse in a designated rural zone for $1 million, and let's say you hold it for 5 years and it's now worth $2 million. You have $1 million gain.
Right, which I'd have to pay capital gains tax on.
Normally, yes. But under this law, the government might treat your basis, your starting price, as, say, $1.3 million instead of the $1 million you actually paid. It gives you a 30% step up. So now your taxable gain is only $700,000. It's a huge tax break. It creates a massive tax shelter for capital flowing out of cities and into the countryside.
So it's a magnet for money, for investment in those areas.
It's a massive magnet. It's designed to spur development outside the major metro areas.
So on the surface, this all sounds like a lot of money flowing out to people. Tax cuts, deductions, shelters. But that brings me to my favorite question in economics. And it's the one that usually ruins the party.
I know where you're going with this.
How are we paying for this?
Do
Can't
you?
just cut revenue by this much without consequences somewhere else.
And that is where the DOGE comes in, the acronym of the year.
The Department of Government Efficiency.
Correct. To pay for the OBBA, the administration has implemented what they are calling the DOGE cuts. And we are talking about $1.2 trillion in spending slashes over the next decade.
$1.2 trillion.
And they aren't cutting defense, they aren't cutting infrastructure, they are targeting the social safety net aggressively.
Where specifically? What's on the chopping block?
Healthcare is taking the biggest hit by far. A $1.1 trillion cut. That's reductions in Medicaid, it's subsidies for insurance on the exchanges, gone.
$1 trillion from health.
Then you have student loans. Another $305 billion in forgiveness programs or subsidies are gone. And SNAP, the food stamp program, is cut by $185 billion.
Wait, let's connect that back to what we just said about the consumer. We have low-income spending on food down 2.4%. People are already eating less or eating worse. And now the government is cutting $185 billion from food assistance.
You see the tension. You see the polarization right there. It is a sugar rush policy. The tax cuts boost growth and asset prices right now, which explains the booming stock market and the wealthy consumer. But by slashing the safety net, you are removing the floor for the people who are already struggling.
It's a bet.
It's a huge bet. You are betting that the growth will eventually trickle down and trickle down fast enough. But in the short term, you are pulling the rug out from under the bottom 30% of the economy.
It creates a high-growth, high-risk economy. If you're winning big. But if you fall hard.
Exactly. There's nothing to catch you.
And there's another rollback involved here regarding energy, right?
Yeah.
I know a lot of people were banking on those solar credits from the old laws.
Yes. The OBBBA essentially repeals the Inflation Reduction Act credits. So if you are planning to put solar panels on your roof or buy a heat pump or make other energy-efficient home improvements, those tax credits are gone as of December 31st, 2025.
They're just gone.
That fiscal support for the green energy transition has been pulled completely to help pay for the other tax cuts.
So the government is basically making a choice. It's saying, we don't care about your solar panels. We care about your overtime pay and your domestically built car.
That is the explicit prioritization: fossil fuels and labor hours over green transition.
So we have a fiscal landscape that is very pro-growth, pro-business, but, very harsh on the safety net. Now, let's pivot to the money supply. Because usually when the government steps on the gas with tax cuts like this, the Federal Reserve might tap the brakes to stop inflation from coming back. But the Fed is going through its own drama.
That is a great way to put it. We are seeing a major pivot in monetary policy. Just last week, late January, the Fed held rates steady at that 3.50 to 3.75% range.
Which was a change.
A big change. This was after 3 consecutive cuts in 2025. So the easing cycle, the party where money gets cheaper, has at least paused.
But the bigger story isn't the rate hold, it's the personnel. Jerome Powell is out, and not with a retirement party and a gold watch.
No, he is out under a cloud. There is an active investigation into his tenure. We don't need to speculate on the legalities, but what we do know is the market hates that kind of uncertainty. However, the market is always looking forward, and the nomination of Kevin Warsh as the next chair is the signal everyone is watching.
Kevin Warsh. He's not a new name in these circles, but for the average listener who might not follow Fed governor appointments, who is he? What does he represent?
Kevin Warsh is a former Fed governor, so he's been in the building. But philosophically, he is very different from Powell or Yellen. He is viewed as an orthodox inflation fighter, a hawk.
What does that mean, orthodox?
It means he believes in a strong dollar. He believes that money should have a real cost, that interest rates should reflect risk. He is not a fan of quantitative easing or, just printing money to solve every problem.
So if Powell was the friendly bartender keeping the drinks flowing to keep the party going, Warsh is the bouncer who comes in at the end of the night and turns on the bright lights.
That is a perfect analogy. The market interprets his nomination as a clear signal for higher for longer rates. He isn't going to cut rates just to make the stock market happy. He will only cut if inflation is well and truly dead.
And that expectation that rates aren't going to drop back to zero and that the dollar is going to get stronger, that caused absolute chaos in one specific corner of the market recently.
Oh, yeah.
We have to talk about the precious metals crash.
It was a bloodbath, an absolute bloodbath.
Gold and silver were the darlings of 2025. They were hitting record highs. Everyone I knew was buying silver coins or gold ETFs. They were convinced the dollar was dying, that inflation was permanent, and then, boom, February hits. What on earth happened?
It was a violent move. Gold dropped about 9% down to the $4,400. Silver tumbled 15% down to around $71 an ounce. And to understand why, you have to understand leverage and the psychology of what's called a crowded trade.
Okay, unpack that.
Yeah.
Because I thought gold was supposed to be a safe haven.
Yeah.
Why does it crash when things get uncertain like this?
Because a lot of the money pouring into gold wasn't just, people buying a few coins to bury in the backyard. It was hedge funds and large institutional investors buying gold futures with borrowed money, with leverage.
They were magnifying their bets.
Massively. They were all making the same bet that the Fed would keep cutting rates and the dollar would continue to weaken. That was the Powell trade.
So they borrowed a ton of money to bet against the dollar, using gold as their vehicle.
Exactly. Then Kevin Warsh gets nominated. Suddenly, the entire outlook flips 180 degrees. The new expectation is for a strong dollar, and a strong dollar is kryptonite for gold.
Because gold is priced in dollars.
Right, so the price starts to dip. And because these investors are so highly leveraged, that small dip triggers a margin call.
Okay, explain the margin call for us. What does that feel like for a trader?
It's the nightmare scenario. It's a call from your broker. You borrowed money to buy, say, $1 million of gold, but you only put up $100,000 of your own cash. The price drops 10%. Now your position is only worth $900,000, which means all of your own money has been wiped out. The broker calls and says, your collateral isn't enough anymore. You need to deposit more cash right now, or we sell your entire position to cover the loan.
And if everyone gets that same call at the same time?
And they don't have the cash, or they just want to cut their losses, they have to sell. And that selling drives the price down further, which triggers more margin calls for other investors who had a little more breathing room. It becomes a self-feeding loop, a liquidation cascade.
A death spiral.
Exactly. It wasn't that the world suddenly decided gold was worthless. It was a positioning shock. Everyone was on the same side of the boat, and when the boat tipped, they all had to rush for the exit at the exact same time.
So it wasn't about the fundamentals of supply and demand for physical gold. It was about the market plumbing exploding.
Precisely. It was a liquidity event, plain and simple. Cash is king when the margin calls hit, and they had to sell whatever they could, in this case gold and silver, to get cash.
This shift to Warsh also affected the bond market.
Yeah.
I kept seeing the term bear flattening in the research notes. That sounds like a terrifying animal. What does it mean for the economy?
It does sound technical, but it's actually a very clear signal from the bond market. Think of the yield curve like a prediction of the future. Usually, you get paid more interest to lock your money away for 10 years than for 2 years, right? So the curve slopes up.
Right, because 10 years is more risk, more uncertainty.
Exactly. A bear flattening means short-term rates, like the 2-year yield, are going up because investors think Warsh will keep rates high right now to fight inflation. But long-term rates, like the 10-year, are staying anchored or rising much, much slower.
Why a difference?
Because the bond market is worried that this tight policy today will choke off growth in the long run. It's like they're saying, this medicine might kill the patient.
So the market is essentially saying rates will be high today, but that's going to break something in the economy, so rates will have to be lower later on to fix it.
That's it in a nutshell. The curve gets flatter. It's a vote of no confidence in the long-term growth prospects if we keep rates this high. It's the bond market waving a yellow flag, warning us that the orthodox management might be too strict for this economy to handle.
Which brings us back to the reality for businesses.
Right.
The free money party is officially over.
Yeah.
You have to actually have a solid business case and real profits now.
Right. And speaking of business cases, we have to talk about the backdrop these businesses are operating in. Because 2026 isn't just about tax bills and interest rates. The geopolitical landscape has turned into an absolute action movie.
Seriously, I mean, if you pitch this script to a Hollywood studio, they'd probably say it's too much, too unrealistic. Let's talk about January 3rd, 2026. The raid in Venezuela.
This was a massive, massive event. We are talking about U.S. Special Forces conducting a raid in the capital, Caracas, and capturing the sitting Venezuelan president, Nicolas Maduro.
Just captured him, like something out of the 19th century. I had to play devil's advocate here for a second. You're talking about this in the context of Chevron's stock price, but we just saw a U.S. military operation depose a foreign leader. Doesn't that introduce massive instability? Why is the market treating what is effectively a coup like a ribbon-cutting ceremony for a new factory?
It's a great question, and it speaks to frankly, the cynicism of the market. The market doesn't care about diplomatic norms or international law. It cares about barrels of oil.
So it's all about the oil.
It's all about the oil. Venezuela has the largest proven oil reserves in the world, but under Maduro, their infrastructure was rotting. Output was a tiny fraction of what it could be. The market sees this as a change in management.
A hostile takeover, essentially.
Exactly. As cold as it sounds, that's how Wall Street sees it. Energy stocks surged. Chevron was up 5.5% the next day. Distressed Venezuelan government debt, which was trading for pennies on the dollar, jumped 20% overnight.
Because the bet is that the new government will actually pay its bills.
Right. The market is betting that with Maduro out, the U.S. is going to help install a new, friendly administration and, crucially, rebuild that oil infrastructure. Chevron goes back in, Halliburton goes back in, they rebuild the pumps, fix the refineries.
And the expectation is that Venezuelan oil output could, what, double? Triple?
The initial estimates are that it could double in a relatively short time. Now think about what that does to the global price of oil.
A flood of new supply means lower prices for everyone.
A lot lower, which is why the long-term forecast for oil is now hovering around $58 a barrel. That is low. That is a massive deflationary force for the global economy. It helps consumers at the gas pump, maybe offsetting some of those higher food costs we talked about, but it completely changes the calculus for other energy companies and for entire petrostates.
So we have the U.S. effectively taking control of Venezuelan oil output to drive prices down. But that wasn't the only, let's say, territorial ambition on the table in the last month. We have to talk about the Greenland crisis. This one, I honestly thought it was a joke when I first read the reports.
It sounds like a joke, but the consequences were very, very real. The U.S. administration proposed buying Greenland from Denmark again. But this time, when they were rebuffed, they didn't just, tweet about it. They threatened 25% tariffs on key European allies, Denmark, Germany, the U.K.
The threat was literally, sell us the island, or we will tax your Mercedes and your Scotch whiskey into oblivion.
That was essentially the message. And it escalated fast. We saw Arctic endurance, military exercises being announced, NATO tensions spiking. For a moment there, it really looked like the Western alliance was going to crack over what started as a real estate deal.
But it de-escalated at Davos, right? They all got together and shook hands.
It did. A framework deal was reached, some face-saving compromise. But the damage is done in terms of investor psychology. We now have what analysts are calling a permanent uncertainty premium on transatlantic trade.
What does that actually mean for a company? Say I'm the CEO of a logistics firm that ships goods between Europe and the U.S.
It means your life just got a lot more complicated and expensive. It means you can't just plan for supply and demand anymore. You have to actively hedge against the possibility that the U.S. president might try to buy land mass and threaten massive tariffs if he doesn't get what he wants.
You have to buy insurance against political whims.
Exactly. Geopolitics is no longer just background noise. It is a primary driver of asset pricing. It adds friction to the entire global economy. It creates inefficiencies because everyone is constantly looking over their shoulder.
Okay, so let's try and recap where we are. We have a hiring recession where nobody can get a new job. We have a slashed social safety net. We have a crash in precious metals that wiped out a lot of retail investors. And we have these wild geopolitical risks with presidents getting captured and islands being bid on. And yet, we get to Section 5. The market engine keeps humming. The S&P 500 is pushing record highs. Why? Are investors just completely delusional?
They aren't delusional. They are just focused on one thing, profitability. And the driver of that profitability is the AI supercycle.
We've been hearing about AI for years. Is it actually different now? Is this not just more hype like we saw with the dot-com bubble or crypto?
It is completely different now because now it is capital-intensive reality. It's not just hype. It's infrastructure. We are seeing massive real-world builds in data centers and semiconductor fabrication plants. And the proof is in the profit margins. S&P 500 net profit margins hit a record 13.2% in the fourth quarter of 2025.
13.2% across the entire index.
Across the entire index. And if you zoom in on just the tech sector, the margins are at 29%.
29% profit margins. That is unheard of. That means for every dollar in revenue they take in, they keep almost 30 cents as pure profit.
It's incredible efficiency. And this goes back directly to the labor market point we started with. These companies are generating massive amounts of cash without needing to hire thousands of middle managers or support staff. The software does the work. The AI does the work.
So the stock market loves it because it's hyper efficient.
Yeah.
But that efficiency is the exact reason why the hiring market is dead for so many people.
Exactly. It is a zero-sum game between capital and labor right now. And capital's winning, hands down.
Interestingly, though, looking at the data, It's not just the Magnificent Seven tech giants anymore. We're seeing what the analysts are calling a broadening out of the rally.
Yes, I noticed that in the notes too, and it's an important development. The Russell 2000, the index of small cap stocks, is rallying hard. It's up 5% in just the last month. That is a huge move for that index.
Why them? Why now? I thought small companies would be hurt by higher rates.
That ties back to the OBBBA tax cuts. Who benefits most from domestic tax cuts and
Yeah.
deregulation? It's not the giant global multinationals who can already hide money offshore. It's the domestic-focused mid-tier U.S. companies. The manufacturers, the regional banks, the domestic retailers, they are the big winners of the new tax regime. Remember the Made in USA car loan rule? That helps all their domestic suppliers.
The little guys, well, relatively little, are finally catching a bid. That's at least some good news for the domestic economy outside of big tech.
It is, and we're even seeing some really interesting bright spots internationally. You have to look at Japan.
Japan. Japan has been the sleeping giant for, what, 30 years?
Well, the giant is awake. Japanese markets are having their best start to a year since 1990.
That is saying something. 1990 was the absolute peak of their bubble.
It's being driven by their new prime minister, Sane Takaichi, and her aggressive policy of Sananomics.
Sananomics. Seems everyone gets their own nomics these days. What is it?
It's a potent mix. It's big fiscal stimulus, a $135 billion package, combined with some pretty aggressive corporate governance reform. She is essentially forcing these huge, old Japanese companies to stop sitting on enormous piles of cash and start spending it on buybacks, dividends, and wage increases.
And are wages finally moving there after decades of deflation?
They are. Real wage growth in Japan is finally turning positive. So you have these pockets of incredible optimism in Japan, in U.S. small caps, in AI tech that are counterbalancing all the gloom in the labor market and the geopolitical chaos.
It really is a split-screen world. You just have to choose which screen you're looking at.
That's a perfect way to put it.
So let's try to synthesize all of this for the listener. We've covered a massive amount of ground. We are here in February 2026. And the economy, it seems, is running on these two powerful twin engines, AI productivity and the aggressive fiscal tax cuts from the OBBBA.
Correct. Those are the accelerators. That's what's pushing the S&P to 7,000.
But at the exact same time, we are navigating a hiring freeze. Companies are more efficient than ever, but they aren't sharing the wealth via jobs. And the government is slashing the safety net to pay for those tax cuts.
And overlaid on top of all of that is this new era of aggressive geopolitical maneuvering, Venezuela, Greenland, that adds a layer of volatility and risk that we haven't seen in decades.
It feels like a winner-takes-all economy, more than ever before.
That is the perfect summary. It is a fantastic economy for high-margin tech companies. It is a fantastic economy for high-net-worth individuals who own assets and can deduct their auto loans and invest in rural opportunity zones. But it is a much, much tougher economy for those relying on traditional wage growth, or for young people looking for entry-level jobs, or for anyone who might need to rely on the social safety net.
Which brings us to the final thought. We always like to leave the listener with something to chew on, something provocative, because this really feels like a turning point, a fundamental shift.
Here is what I am thinking about, what I can't shake. We are seeing two massive decouplings happening simultaneously. First, there's the decoupling of economic growth from human labor.
What do you mean by that?
We can grow GDP by 2.2% without adding any significant number of jobs. We can do it because of AI and automation. That breaks a fundamental rule of 20th century economics. We used to need people to grow. We might not anymore.
And the second decoupling?
It's the decoupling of fiscal policy from social welfare. The OBBA is designed to boost growth, but it does so by cutting the safety net. It implicitly says the government's job is to fuel business, not to protect the vulnerable. So, here is the question that I think we all have to grapple with. If the economy can grow without workers, and the government is stepping back from supporting the vulnerable, what does the social contract even look like by 2027?
That is a heavy question. If you don't need workers to make money, and you don't support the people who aren't working, where do those people go? What happens to the stability of the entire society?
Exactly. Are we building an economy that no longer needs its own workforce to succeed? And if we are, who is this economy actually for? Is it just for the shareholders and the asset owners?
That is something I think we are going to be debating for a long, long time. And frankly, the answer to that question might determine whether this bull market can survive the social pressure that it's creating underneath the surface.
I think so too. I think it's the defining question of the decade.
Well, on that cheerful note, we're going to wrap it up. We hope this helped you connect some of the dots in this crazy landscape we call 2026. Thanks for joining us on the Deep Dive.
Thanks for listening.